For 53 straight years, through every recession, market crash, and global crisis you can think of, one company has managed to give its investors a raise. Every single year. That company is PepsiCo, a name that for income investors has been synonymous with stability, a true financial fortress. It's a dividend king, one of the most elite and resilient companies on the planet. But even the strongest fortress gets tested. PepsiCo just dropped its first quarter earnings report for 2025, giving us our first real look at how this giant is handling today's shaky economy. So the big question is that fortress still standing strong? Or are we starting to see the first cracks appear? We're about to dig into the numbers, uncover the story behind them, and figure out what it all means for your money. If you're an investor who cares about reliable, growing income, then you're in the right place. We're not just looking at a random stock today. We're examining a cornerstone of countless retirement portfolios. The title Dividend King is a huge deal. It means a company has been so successful it can consistently reward shareholders for over half a century. PepsiCo has earned that crown thanks to its iconic brands and incredible financial discipline. But the market always looks forward. That 53-year streak is history, but is it a promise for the future? That's why this new earnings report is so critical. First, we'll look at what made PepsiCo a dividend fortress in the first place. The brands and the global scale that built this legacy. Then we'll put on our Wall Street analyst hats and break down the Q1 2025 report card, from revenue to profit and what management sees coming. And finally, we'll weigh the good against the bad and answer the ultimate question. Is PepsiCo's legendary dividend still a safe bet? And is the stock a buy, hold, or sell right now? Section 1. The legacy of a dividend fortress. Before we judge PepsiCo today, we have to respect the past. What does it really take to become a dividend king with a 53-year streak of raising dividends? Think about the last 5 decades. We're talking about the 70s oil crisis, the Black Monday crash in '87, the dot-com bust, the 2008 financial crisis, a global pandemic, and wave after wave of inflation. Through all of that, PepsiCo never once failed to give its shareholders a bigger dividend check. That isn't luck. It's the result of a brilliant business model built on 2 key pillars: a wildly diverse portfolio of famous brands and an unmatched global scale. Let's start with the brands. You hear PepsiCo, you think of a can of soda, but that's not even scratching the surface. This company is a food and beverage titan. It owns more than 20 brands that each rake in over $1 billion a year. We're talking about Frito-Lay, the absolute king of snacks with names like Lay's, Doritos, and Cheetos. We're talking about Gatorade, which owns the sports drink market. And then you have Quaker, Tropicana, Mountain Dew. The list goes on. This diversification is its secret weapon. If soda sales are flat, the snack business usually picks up the slack, and vice versa. This creates the kind of stable revenue that other companies dream of. These aren't fancy luxury items, they're affordable treats and pantry staples that people buy even when money is tight. This recession-proof quality is what generates the steady, predictable cash flow needed to fuel that dividend. The second pillar is its global reach. PepsiCo operates in over 200 countries, which gives it fantastic geographic diversification. If the US market is struggling, which as we'll see, it is, strong growth in places like Asia, Latin America, or the Middle East can balance things out. And they're smart about it, tweaking their products to fit local tastes. They aren't just selling the same bag of Lay's everywhere, they're creating flavors that connect with billions of different people, with markets like Brazil and India showing particular strength. You combine these must-have brands with that massive global footprint, and you get a financial fortress. You get a company with the muscle to reinvest in itself and keep its promise to shareholders. That promise was just renewed with another 5% dividend increase starting in June 2025, keeping that 53-year legacy alive. That's the standard we're measuring today's performance against. Section 2. The Q1 2025 Report Card, a deep dive. All right, enough with the history lesson. Let's get to the here and now. It's time to crack open the Q1 2025 earnings report. This is our progress report for the company, and it tells us how PepsiCo is really doing. We'll focus on 4 key things: revenue, earnings per share, EPS, how each part of the business did, and what management is telling us about the future. First, revenue, the top-line number showing how much cash came in the door. For Q1, PepsiCo reported net revenue of about $17.9 billion. That was actually a little better than what Wall Street expected, which is a good start. But here's the catch. That number was down 1.8% from the same time last year. A big reason for that was a strong US dollar, which makes money earned in other currencies worth less when it's brought home. That's why we look at something called organic revenue. It strips out currency effects and gives you a cleaner look at the core business. PepsiCo's organic revenue grew by 1.2% this quarter. Now, growth is growth, but 1.2% is pretty slow and tells you things are tough out there. Next up is earnings per share, or EPS. This is the bottom line, the profit. PepsiCo's core EPS came in at $1.48. This was just shy of the $1.51 analysts were looking for, meaning profitability was under a bit more pressure than expected. So revenue was a little better than feared, but still down, and earnings were a miss. It's a very mixed bag. So where's the pressure coming from? That brings us to our third piece, segment performance. This is where you see the power of PepsiCo's diversification, but also its weak spots. The star of the quarter was the international business, which posted a solid 5% organic revenue growth. This was the 16th quarter in a row of strong growth for the international segment, with international beverages leading the pack with an incredible 11% growth. Markets like China, India, and Mexico showed really strong demand, making up for the slowdown in other places. And that brings us to the problem child, North America. Frito-Lay North America, usually the company's reliable cash machine, had a quiet quarter. The PepsiCo Beverages North America division was also soft. The weakness in the US boils down to a few things. Consumers are being more careful with their money. After a year of price hikes, some are just buying less or switching to store brands. The company also had some operational hiccups, including a product recall that didn't help. The contrast is pretty stark. The global business is humming, while the home field is a struggle. Finally, and maybe most importantly, is management's guidance. This is where the bosses tell investors what they think will happen for the rest of the year. And here, PepsiCo had some worrying news. They kept their forecast for low single-digit organic revenue growth for the full year. But they changed their profit outlook in a big way. They used to expect mid-single-digit growth in core EPS. Now they expect it to be flat compared to last year. Why the downgrade? They pointed to a more volatile and uncertain economy, specifically new tariffs and global trade issues that are going to make their supply chain more expensive. This is a huge deal. It means even if they sell the same amount of stuff, it's going to cost more to make and deliver it, squeezing their profits. That cautious tone from management was a clear warning that 2025 is going to be a tougher road than anyone thought. Section 3. The bull case versus the bear case. So we've got a legacy of strength hitting a wall of modern-day challenges. This sets up a classic Wall Street tug-of-war. The bull case versus the bear case. Let's argue both sides. First, the bull case. Why would an investor look at this report and think it's time to buy? The bull argument stands on three legs: timeless brand power, strong international growth, and a track record of smart leadership. Bulls will say that even with some weakness in the US, PepsiCo's brands still give it incredible pricing power. They raised prices to fight inflation, and while that caused some short-term grumbling, it kept revenues from falling off a cliff. That pricing power comes from decades of building loyalty. People don't just ask for a soda, they ask for a Pepsi. They don't just want a chip, they want Doritos. That creates a competitive advantage that's almost impossible to beat. Bulls believe the slump in North America is just a temporary dip caused by nervous consumers, and it will pass. They'll point to management's plan to push value-friendly brands like Santitas to win back shoppers watching their wallets. On top of that, Bulls are thrilled about the international story. A 5% organic growth rate there is fantastic. And 11% growth in international drinks shows the global strategy is working perfectly. Since PepsiCo operates in over 200 countries, it doesn't live or die by the US market. As emerging economies grow, hundreds of millions of new middle-class customers will be ready for snacks and drinks, and PepsiCo will be there to greet them. This global growth engine, bulls argue, can more than make up for a temporary U.S. slowdown and will drive the stock for years to come. Finally, bulls will say that this management team has proven itself time and again. You don't get a 53-year dividend streak by accident. It comes from decades of smart decisions and a deep commitment to shareholders. They've weathered countless storms before, and they'll get through this one. The fact that they just approved another 5% dividend hike while warning about lower profits shows just how confident they are in the long-term cash-generating power of the business. Now let's flip it. What's the bear case? Why would this report make an investor nervous? The bear argument focuses on a sky-high payout ratio, weakness in their most important market, and a cloudy profit outlook. Bears will immediately point to the dividend payout ratio, the percentage of profits paid out as dividends. Right now, PepsiCo's payout ratio is dangerously high, hovering near 100% of its earnings. A ratio that high is a red flag. It means there's almost no wiggle room. If profits fall more than expected, the company faces a terrible choice: cut the dividend, which would destroy its reputation, or borrow money to pay it, which isn't a long-term solution. Bears argue that the latest dividend increase, while nice for now, was reckless when they knew profits were going to be flat. They believe future dividend hikes will have to be much smaller than the 7 to 8% investors have gotten used to. Second, bears are very worried about the weakness in North America. The US isn't just any market, it's their home turf and biggest moneymaker. The slowdown here can't be brushed aside. Bears see the drop in Frito-Lay and beverage volumes not as a blip, but as a sign of a real problem. Have years of price hikes finally pushed customers too far? Are people really switching to healthier foods or cheaper store brands for good? The bears worry this could be the start of a long-term decline in their most critical region. Finally, bears will zoom in on that revised guidance. Going from mid-single-digit growth to flat for core EPS is a major downgrade. It confirms that rising costs from tariffs and supply chain problems are real and will chew through profits. With costs going up and sales volumes in their main market going down, the bears see a recipe for shrinking margins and disappointing results. They think that even after its recent price drop, the stock might not be as cheap as it seems because the E in the PE ratio is at risk. So there it is, the bull case, banking on brand loyalty and global growth versus the bear case, focused on that payout ratio and trouble at home. Now that you've heard both sides, I have to ask, which side are you on? Are you a bull, confident in PepsiCo's long-term strength, or a bear, worried about the immediate challenges? Drop your take in the comments below. I read every single one, and your thoughts help all of us become smarter investors. And if you're getting value from this analysis, do me a favor and hit that subscribe button. We work to bring you the insights you need to invest with more confidence. So after looking at the history, the Q1 2025 numbers, and the arguments for and against, what's our final take on PepsiCo's dividend fortress? The fortress is still standing, but this latest report has definitely revealed some cracks in the walls. The 53-year dividend streak isn't in immediate trouble. The company's massive cash flow and global business give it a huge safety cushion. And management's commitment, shown by that recent 5% dividend hike, proves they'll do whatever it takes to protect that streak. It's part of their identity. However, the days of easy, automatic growth seem to be on hold. The challenges are clear: a squeezed consumer in North America, rising costs, and a high dividend payout ratio that leaves very little room for error. The downgraded profit forecast for 2025 is a frank admission from the company that this will be a tough transitional year. For investors, this means PepsiCo is shifting from a growth and income stock to more of a high-yield defensive income stock. But you have to lower your expectations for future dividend growth. Hikes in the low to mid single digits seem much more likely until the company can fix its problems and get sales growing again in North America. Based on these Q1 earnings, PepsiCo's dividend fortress seems strong enough to handle the current storm, but we are officially putting the company on watch. The number to obsess over for the rest of the year is organic sales volume in North America. If it keeps falling, the pressure on that fortress is going to build. If it starts to stabilize, it'll be a sign that management has things under control. The story is no longer simple and steady. It's a complex battle between global strength and domestic weakness. And that makes it one of the most compelling stories to follow in the market right now.